Hi folks, Chuck Gibson from Financial Perspectives in San Ramon, California with July 2017's Charts on the Move. Since not a whole lot has changed since my last video, I'm going to keep this one short. There's no sense in overcomplicating the analysis as we are within a strong bull market. At some point, it will end, but there's nothing in the charts that's telling me that time is now. While I am seeing some small cracks appearing in the market's foundation, as of now, they are minor, and as such, they will not be a part of this video. So let's get to it. My first chart is that of the S&P 500 US Stock Index. As you can see, price still remains above the second blue uptrend support line. Any and all pullbacks are being bought. On the downside, divergence is forming but not yet confirmed in the upper pane of momentum. The last time it confirmed, we had the one and only significant pullback. One other item that is worth noting is how far away price is from the 200-day moving average. Hopefully it makes sense that the further away something gets from its average, the higher the probability of a reversion to the mean. I've talked about this ad nauseum, so there's no sense to beat this dead horse. As of now, we are tied with being the second furthest away from the moving average over the past 5 years. If this doesn't get resolved through a sideways consolidation, then the only other resolution will be for prices to go lower. I know I'm sounding like the boy who cried wolf as I keep bringing this up. But this is normally what markets do. Really. But in very strong bullish uptrends, the markets are extremely resilient, and normal no longer is. The next two charts help illustrate how strong this market has really been. In the first chart, in the upper area in blue, is the S&P 500 index, while the black spikes at the bottom of the graph are the number of years without a 5% correction. While not the largest, you can see it's been more than 1 year since the S&P has pulled back more than 5%. Hey, don't get used to this because, as you can see, this is not normal. My second chart is a look at the size of maximum drawdowns on the S&P 500 in blue, the emerging market stocks in black, Japan's Nikkei in green, and the rest of the world, which is the MSCI EAFE index, in yellow, and these are shown by year. This chart goes back to 1990, and as you can see, 2017 has been the calmest year ever, with only Japan's Nikkei being the only index that has a greater than 5% correction. The next closest year in market calm was 1999, the final year before the dot-com bust. Interesting stuff. On to my next chart of Europe. You can see this index sits just under this major resistance, a level that has failed 3 times in the past to get through. Will the 4th time be a charm? It seems to me we'll likely get an answer to this question sometime later this year. If we do, a breakout in Europe will be a very bullish catalyst for stocks worldwide and extend this bull market. Interestingly, the emerging markets are at the same critical juncture that Europe is, as you can see in my next chart. While the chart does not look anything like Europe's, the emerging markets index is also sitting right under major resistance. Unfortunately, RSI momentum is extremely overbought and is warning the index is in need of a rest before it can take on making another push to break out to all-time new highs. What really caught my eye is what's happening to relative strength in the bottom pane. This ratio of the emerging markets to the S&P 500 index shows a very strong, in fact more than 50% underperformance of the emerging markets as compared to US stocks since 2010. But just recently, the ratio bottomed, formed this nice consolidative base, and also has made a series of higher highs and higher lows. Because this is typically what you want to see when a new trend is beginning, if the breakout should hold, this points to the chance that we are in the early stages of a multi-year trend. Armed with this data, an investor should consider minimizing their US stock index exposure and overweight the emerging markets. But before we go overboard with emerging market giddiness, it's always smart to look at what's going on with the dollar, as it's the 10,000-pound gorilla in the room. Are the emerging markets doing better because of true fundamental strength, or because central bankers are playing with their currencies? My next chart of the US dollar shows it, like Europe and the emerging markets, is sitting right at a critical level. Since the dollar and foreign stocks are inversely correlated, if the dollar were to break down right here, below support and hold, I would expect Europe and the emerging markets, and every other foreign asset for that matter, to move higher. If, on the other hand, this level acts as support for the dollar, as it has so many times in the past, and reverses course higher, You would expect to see Europe and the emerging markets get rejected at their current critical support and in fact turn lower. The bottom line here is that so many things I'm watching are at a crossroads and at least partially hanging on, waiting for a signal from Uncle Buck. As such, it's never been more important to keep it on our radar before making any further investment moves. And speaking of potential trend changes, a look at the energy sector ETF XLE shows price has been in a strong downtrend, falling 18% and decisively through its 200-day moving average. With price having formed a hammer candle here on the recent low and one higher high, it's beginning to look interesting. In spite of this, I'm very skeptical because every consolidation over the past 6 months where the same thing has occurred, it's failed to hold and it's turned lower. What may make it different this time is positive RSI momentum divergence has developed after being oversold. Is this enough to push it over the edge in reverse course? While no guarantees, this increases its odds that this could be the real deal. At least it's set up for a tradable bounce. There's been substantial buzz in the investosphere about the new low being created on the VIX. For those that are unfamiliar, the VIX is just a measure of market volatility. It looks at the ratio of the number of put to call options on the S&P 500. The VIX is commonly referred to as the fear index because as investors become fearful, they buy protective puts. As the fear wanes, calls are purchased in anticipation of higher prices. Remembering the prior chart of how long it's been since we've had a 5% pullback, it sort of makes sense why the VIX printed an all-time low. In the upper pane of this chart is the S&P 500 stock index, and the lower pane is the VIX ratio. As you'd expect, they're inversely correlated, meaning as fear rises, more selling occurs and prices decline, the VIX rises. The converse is true too. The real problem of a low VIX is not the fact that it's so low, but rather it's an indication that investors have become too complacent. This complacency, when combined with a massive proliferation of passive investing, low volatility funds, and ETFs for everything under the sun, it will result in substantially less liquidity. Someday, we'll see a major liquidity event and all the systems that are in place to protect you will not be sufficient enough to stop the deleveraging sequence, which will result in a chain reaction cascade lower in stock prices. It's not going to be pretty. Just 2 more non-related charts before I wrap this up, so hang in here with me. The first chart puts the current economic expansion into context. You can see, as of now, the move from 2009 is the 3rd longest period since 1845. We are in our 95th month, which is more than 50% above the average expansion since 1945. The takeaway here is we are likely closer to the end rather than the beginning of a rising stock market. Since no one rings a bell at the top, you're going to only know after the fact. My final chart is a look at the S&P 500 seasonality, and we can see that while not as strong as July, August on average has had the index close higher than it has started, which bodes well for continued calm and higher prices. Yeah, I see what comes up next month, but we're going to cross that bridge when we come to it. Have a great August, and until next month, as always, appreciate your time and attention, and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with July 2017's Charts on the Move.